What if the greatest trick in American history wasn't political, but financial? What if the Federal Reserve isn't federal, has no reserves, and serves no one but the bankers who built it? Every time prices rise, every time your savings lose value, every time you swipe your card and get charged interest, someone profits. But who? We've been taught inflation is natural, recessions are unavoidable, and the Fed is a guardian of stability. But what if all of that is a lie? Over a century ago, a small group of bankers on a private island wrote the rulebook of money. That rulebook didn't just change banking, it redefined power. It turned currency into debt, citizens into collateral, and freedom into a loan you'll never fully repay. You feel it every day. Groceries up, wages flat, credit tighter. That's not coincidence, that's design. By the end of this story, you'll see how 7 men on Jekyll Island created a machine that prints not wealth, but control. Before we begin, where are you watching from? Comment your country below. And subscribe for the unfiltered truth they never taught you in school. Because once you see the pattern, you can't unsee it. Our story starts not in Washington, but in secrecy. The year is 1910. A private rail car leaves New Jersey, its windows blacked out, carrying the men who will change money forever. Newspapers called it a duck hunting trip. It wasn't. Inside that train was a staggering concentration of wealth. Senator Nelson Aldrich, whose daughter was married to John D. Rockefeller Jr., Henry Davison of J.P. Morgan and Company, Frank Vanderlip, the president of National City Bank, and Paul Warburg, a partner at Kuhn, Loeb & Co. Together, these men represented nearly 1/4 of the entire world's wealth at the time. Their destination? A private, exclusive club on Jekyll Island off the coast of Georgia. Their mission? To design a central bank for the United States, one that would give private financiers control over the nation's money supply, all without the public ever realizing it. At the time, America was plagued by financial panics. The banking system was unstable. Banks would frequently collapse, and when they did, depositors lost everything. The bankers sold their idea as the cure. They promised a permanent lender of last resort, an institution that would provide stability and prevent these crises. Sound familiar? Every crisis today, from 2008 to the pandemic, comes with the same justification for intervention: stability, systemic safety, temporary liquidity. It's the same playbook, used over and over. The plan they hatched in secret on Jekyll Island became the basis for the Federal Reserve Act. In a move of incredible political cunning, the bill was pushed through Congress just 2 days before Christmas in 1913. Most of Congress had already gone home for the holidays, and the nation was distracted, celebrating with their families. President Woodrow Wilson signed it into law, a decision he would later come to deeply regret, reportedly writing in his journal that he had unwittingly ruined his country. So what did this act actually do? It created the Federal Reserve System, a central bank with the power to issue its own notes, what we call the dollar. But here's the crucial detail they didn't advertise. Each note was born as debt. When the government needs money, it doesn't just print it. Instead, it issues bonds, which are essentially IOUs. The Fed buys these bonds by creating new money out of thin air. The government gets its cash, but now it owes the Fed interest on that money. And where does the government get the money to pay that interest? From you, through taxes. Think about that. Every single dollar in circulation is an instrument of debt, carrying an interest payment. To pay the interest on all the existing dollars, more dollars must be created. It's a system of perpetual motion, designed for perpetual debt. There is never enough money in the system to pay back both the principal and the interest. It's a treadmill you can never get off. By 1929, this new system had fueled the speculative frenzy of the Roaring '20s, creating a massive stock market bubble. And when the bubble popped, it triggered the Great Depression. The Fed, created to prevent panics, failed to stop the worst financial catastrophe in modern history. But while millions of Americans lost their homes, their farms, and their life savings, a few powerful players did exceptionally well. Banks like J.P. Morgan and Rockefeller's Chase National quietly absorbed their smaller, failing competitors for pennies on the dollar, consolidating their power. Sound familiar? We saw the same script play out in 2008. The housing market collapsed, families were evicted, and the global economy teetered on the brink. And who got the multi-trillion-dollar bailouts? Not the homeowners. It was the same Wall Street institutions that caused the crisis in the first place. Then came another critical moment. In 1971, President Nixon temporarily severed the US dollar's last link to gold. This temporary suspension became permanent. For the first time in history, the dollar was backed by absolutely nothing tangible. It became pure fiat money, its value based on nothing more than faith and government decree. From that moment on, the Fed could expand the money supply without any physical limit. And what happened? Inflation soared, the cost of living skyrocketed, and the purchasing power of your savings began to evaporate. Today, we're told that a 2% inflation target is healthy for the economy. But what does that really mean? It means the system is designed to erode the value of your money by 2% every single year. Compounded over time, that seemingly small number has a devastating effect. It means that the money you work so hard to save will lose half its value every 36 years, within a single generation. Since its birth, the Federal Reserve has presided over every single market crash it swore to prevent. The Great Depression in 1929, Black Monday in 1987, the dot-com bubble in 2000, the financial crisis in 2008, the repo market crisis of 2019, and the economic fallout of 2020. Each time, the pattern is the same. Crisis leads to bailout, which leads to an even greater concentration of power in the hands of the few. But the deeper truth is this: the Fed doesn't just print money, it prints influence. Its real weapon isn't the dollar bill, it's liquidity. When the Fed opens the monetary tap, markets breathe a sigh of relief and asset prices soar. When it closes that tap, credit tightens, businesses struggle, and entire nations can choke. That isn't economic governance, that's leverage. It's a control mechanism on a global scale. Let's go back to the 2008 meltdown. While the headlines were filled with talk of the $700 billion TARP bailout, something much, much bigger was happening behind the scenes. A 2011 government audit revealed that the Federal Reserve had secretly created over $16 trillion in emergency loans to bail out the financial system. For perspective, that is more than the entire gross domestic product of the United States that year. And where did this money go? To the big American banks, of course, but also to foreign banks in the UK, Germany, Switzerland, France, and beyond. There was no congressional debate, no public approval, no major headlines. That cash didn't stabilize the people. It stabilized the very institutions and their interconnected partners that triggered the collapse in the first place. Now, let's look at the secret gear inside this machine: fractional reserve banking. Most people think that when you deposit $100 in a bank, the bank holds on to your $100. That's not how it works. Under the fractional reserve system, the bank is only required to keep a small fraction of that deposit, say $10. It can then lend out the other $90. But the person who borrows that $90 then deposits it in their bank, which then keeps $9 and lends out $81. And so on. This process multiplies the initial deposit through the banking system, creating money out of thin air. Combine that mechanism with the Fed's power to conjure reserves for the banks at will, and you get a self-replicating debt organism. Every loan is born from thin air, then multiplied through the system, creating value without labor and wealth without production. So, who really benefits from this system of infinite credit and engineered booms and busts? Trace the chain. The benefits flow upstream to the very megabanks that own shares in the regional Federal Reserve banks and sit on their boards. They are the same firms that get the bailouts first. They are the same firms whose associated asset management funds have become the largest shareholders in nearly every major corporation in America. And when you finally follow that paper trail, when you look at the ownership structures and the interlocking directorates, when you trace the flow of money from crisis to bailout to consolidation, one name keeps resurfacing again and again, connecting the dots from Jekyll Island in 1910 to the crises we face today. You won't believe the name, and the receipt is wilder than you think. When the government in Washington spends more than it takes in, which is pretty much always, it issues treasury bonds. Think of these as IOUs. Now, who buys these IOUs? Often, it's the Federal Reserve. And how does the Fed pay for them? It doesn't use your tax dollars. It doesn't dip into a national savings account. It simply creates new digital money, literally just by typing numbers into a computer. These are called bank reserves. In 2020 alone, the Fed's balance sheet, which is its collection of assets, ballooned from $4 trillion to an almost unbelievable $9 trillion. This happened without a single public vote. No new goods were produced, no services were rendered. It was just keystrokes in a digital ledger. This new base money then enters the banking system. Banks take these newly created reserves and use them as a foundation to lend out even more money. This is how mortgages, credit card debt, and car loans are born. They multiply that initial base money through a process called fractional reserve banking. So, a huge portion of the money circulating in our economy isn't backed by anything tangible. It's created from debt, based on reserves that were themselves created out of thin air. Now, what happens when you flood an economy with trillions of newly created dollars? You get inflation. And this isn't some unfortunate side effect. It's a core feature of the system. Since the Federal Reserve was created back in 1913, the US dollar has lost over 97% of its purchasing power. That $100 bill your great-grandparents might have saved? Today, it buys what about $3 would have bought back then. Every time you hear about a new stimulus package or quantitative easing, understand that it's a hidden tax. It's a tax on your savings and your paycheck. The money in your bank account might show the same number, but its ability to buy real things, groceries, gas, a home, is constantly being eroded. This inflation tax is the most insidious of all, because it's never debated, never voted on, and most people don't even realize it's happening. It's the system's built-in revenue model, quietly transferring wealth from the savers and the wage earners to those who get the new money first. This system also creates what economists call moral hazard. This is a fancy term for a simple idea. If you know someone will always bail you out, you're more likely to take reckless risks. Think back to the 2008 financial crisis. Major banks were on the brink of collapse because they had loaded up on toxic mortgage-backed securities, essentially bundles of bad loans. Did they pay the price for their gambling? Not exactly. The Federal Reserve stepped in and bought a staggering $1.7 trillion worth of these toxic assets. The losses that should have bankrupted these private institutions were magically wiped from their books. But that debt didn't just vanish. It reappeared on the public's balance sheet, on your balance sheet. The profits from the housing boom were privatized, but the pain of the bust was socialized. This sent a clear message to Wall Street. Take all the risks you want. If you win, you keep the profits. If you lose, the public will cover your losses. It's a rigged game that encourages the very behavior that leads to crises. The Fed's power doesn't stop at our borders. Because the US dollar is the world's reserve currency, roughly 80% of all international trade is conducted in dollars. This gives the Fed immense leverage over the entire global economy. When the Fed decides to tighten its monetary policy, meaning it raises interest rates and reduces the money supply, it creates a dollar scarcity around the world. Developing nations that have borrowed in US dollars suddenly find their debts much harder to repay. Their local currencies plummet in value against the dollar, and they are forced into brutal austerity measures. We've seen this story play out time and time again in countries like Argentina, Turkey, and Sri Lanka. They become victims of a financial squeeze orchestrated thousands of miles away in Washington, D.C. This is a modern form of colonialism. No armies or navies are needed. Control is exerted through monetary policy, keeping nations dependent on the dollar and subject to the whims of the Fed. You'll often hear that the Federal Reserve is independent of politics. This is one of the most persistent myths in modern economics. The idea is that this independence allows it to make tough decisions for the long-term health of the economy without political pressure. But let's look at the reality. Who are the people running the Fed? The chairs of the Federal Reserve, figures like Janet Yellen, Ben Bernanke, and the current chair, Jerome Powell, often have a revolving door relationship with the very Wall Street firms they are supposed to regulate. They move from powerful positions in government to lucrative roles in the private financial sector and back again. Janet Yellen, for example, went from Fed chair to Treasury Secretary after receiving millions in speaking fees from the big banks. This isn't independent oversight. It's a closed ecosystem. It suggests that the system isn't being regulated. It's being managed by the same group of insiders, whether they're in a public or private role. It's less like a watchdog and more like a case of the fox guarding the henhouse. Since nearly all money in our system is created as debt, the person who controls the interest rate on that debt holds the master key to the entire economy. That person is the Fed chair. The Fed's primary tool is the federal funds rate, which dictates the cost of borrowing money for everything and everyone. When the Fed raises interest rates to fight inflation, it makes it more expensive for businesses to borrow and expand, and for consumers to buy homes and cars. This deliberately slows the economy down, often leading to job losses and recessions. On the other hand, when they cut rates to stimulate the economy, it encourages borrowing and spending, which can lead to asset bubbles and inflation. It's a constant balancing act. But notice who benefits regardless of which way the lever is pulled. In both boom and bust cycles, wealth tends to concentrate at the top. The financial elite are positioned to profit from both rising asset prices and the opportunities that arise during a downturn. The average person, meanwhile, is just trying to hang on. The history of the last century is a series of financial crises, each followed by a bigger fix from the Fed that sets the stage for the next disaster. In the 1920s, easy credit fueled a stock market bubble that ended in the devastating crash of 1929. In 1971, the U.S. unilaterally ended the gold standard, severing the dollar's last link to a tangible asset and opening the door to unlimited money printing. In 2008, the financial system nearly imploded under the weight of an estimated $600 trillion in complex derivatives. The Fed's response? Even more credit and bailouts. Then came 2020, when in response to the global shutdown, an astonishing 40% of all U.S. dollars in existence were printed in just 2 years. Each solution is just a bigger dose of the original problem: debt. The system must expand or die, and each expansion makes the inevitable contraction even more severe. To make all of this seem normal, a specific ideology is taught as objective science in our universities. Economics departments drill students in concepts like monetary neutrality and rational expectations. These complex models and equations create a veneer of scientific legitimacy, but they often obscure a fundamental ideological assumption: the necessity of infinite growth on a finite planet. The curriculum rarely encourages students to question the very foundation of the debt-based monetary system itself. It's treated as a law of nature, not a man-made construct. This isn't education, it's indoctrination. It ensures that generation after generation of economists, policymakers, and financial journalists see the world through the Fed's lens, never questioning the core dogma. So, who are the direct, hidden beneficiaries of this system? While the main Federal Reserve Board in Washington is a government agency, the 12 regional Federal Reserve banks are strange, quasi-private entities. Their shareholders are the private commercial banks in their respective districts. And get this, These member banks are legally entitled to a 6% dividend on their shares each and every year, guaranteed. It's a risk-free return, funded indirectly by the public. While you take risks with your investments and your business, a select group of private banks gets a guaranteed profit, courtesy of the central banking system they are a part of. It's another example of how the system is designed to benefit insiders. If you think the story ends here, you're mistaken. We are on the cusp of the next great evolution of this system: central bank digital currencies, or CBDCs. The Fed is already piloting its own version with a system called FedNow. The official slogan is all about speed and efficiency, instant payments, smoother transactions. But the reality is about surveillance and control. A digital dollar wouldn't just be electronic money like we use today through Zelle or Venmo. It would be programmable cash. This means the central authority that issues it could potentially control how, when, and where you spend your money. They could set expiration dates on your funds to force you to spend. They could block transactions for goods and services they disapprove of. Every single payment you make would be traceable, reversible, and potentially censorable. The endgame here isn't economic stability, it's total obedience. It's a level of control that would make past tyrants envious. For over a century, the Federal Reserve has presented itself as the guardian of our economic prosperity. The truth, however, is that it has become the architect of our dependence. It's a machine designed to convert human labor and real-world assets into financial leverage for a select few. Every crisis, far from weakening it, only serves to expand its power and deepen our collective debt. From the secret meeting on Jekyll Island where it was conceived, to the sterile trading screens where trillions are created today, the fundamental rule has never changed. Debt equals control. Today, we face the consequences. Inflation at 40-year highs, household debt soaring past $17 trillion, and the looming reality of a centralized digital currency. The next financial collapse won't look like the bank runs of the 1930s. It will happen at the speed of code. When liquidity in the system freezes up, as it inevitably will, governments will rush in with their prepackaged solution: a stable, reliable, centralized, programmable money system to save us. The illusion of freedom will quietly auto-update into a system of overt control. So, the question is no longer whether the game is rigged. The question is, why are we still playing? History doesn't just repeat itself, it compounds. The interest on our collective ignorance is getting higher every day. Before you scroll to the next video, ask yourself, are we any wiser than those who came before us? Or are we just walking the same path, wearing fancier suits? If this opened your eyes, share it with someone who needs to see it. Subscribe for more unfiltered truth, because awareness is the only asset they can't print.